Asset allocation is simply the process of deciding how your portfolio is invested. The most important decision is to get the right mix between defensive and risky investments. This should consider elements such as your tolerance for risk, the size of your portfolio relative to other assets you own, and most importantly for many of us, what regular distributions you need your portfolio to provide. The next level of decisions to be made occurs within those two broad categories. What defensive investments should be held and in what proportions? The choices here include cash, term deposits, and government and corporate bonds. On the risky side of your portfolio, the long-term returns are expected to be higher, but that comes at the price of increased volatility or a bumpier ride along the way. Decisions here will allocate between high yield or risky debt, listed property, and Australian and international shares. There are then allocations to be determined within those asset classes. For example, within shares, which sectors to own and which country and regional exposures are most likely to meet your portfolio objectives. At Implemented Portfolios, we believe that managing your asset allocation dynamically is more important than being active in individual security selection. In other words, the decision about how much to own in the financials versus the resources sector is more important than which individual bank or mining company to own. Dynamic asset allocation is a long-term investment strategy that makes big changes in the mix of asset classes in your portfolio, but typically does so incrementally over time. We don't try to make short-term market timing decisions, but we do believe that moving out of expensive assets and reallocating to cheaper ones will provide good long-term portfolio outcomes. The most common approach to asset allocation is known as strategic asset allocation. This is essentially a set and forget approach, which doesn't really consider current valuations or expected future returns. In contrast, one of the important principles in our investment philosophy is that higher prices today imply lower future returns. And of course, the reverse also holds true. Identifying when asset classes become cheap or expensive relative to their fundamental value and relative to the returns available on defensive investments is the core of our approach to dynamic asset allocation. Buying quality asset classes that are out of favour and doing so at attractive prices is a proven method of delivering long-term portfolio performance. It's been said that good portfolio management is about having everyone else agree with you eventually. For more information, please head to implementedportfolios.com.au.